Market tracks gains with mid, small and micro cap stocks outperforming large caps. The Nifty remains range bound but still above that 24,800 mark. Slow climb is what we're seeing. Consumer stocks and banks see buying, and Pharma as well as PSU players cool off.
Block deal actions move stocks. Kalyan Jewellers shines over 6% as 6.4% of the company's equity changes hands. Sources indicate that Warburg Pincus could be the seller, with promoters picking up some of the stake. Eris Life sees a block trade worth around 1,200 crores. Alchem sees a large trade, with the promoter likely selling 0.7% stake.
A CNBC-TV18 exclusive. Sources say the government is likely to give relief to Infosys on its recent GST tax notices via affecting changes in the upcoming GST Council meeting. GST relief and clarity also likely for foreign airlines and foreign shipping companies.
Another CNBC-TV18 exclusive. Sources indicate that the government may not be looking at issuing more tranches of sovereign gold bonds, which are being seen as expensive borrowing instruments. Final review on SGBs likely to be taken next month. Hello and welcome. You're watching Halftime Report on CNBC TV18. I'm Ekta Batra. With me is Mangalam Malu. Well, no complaints really coming in for the markets today. And that is courtesy the US Fed minutes, which has really stirred up the optimism that, yes, there could be a rate cut coming in from the Fed finally in the month of September. In fact, there are some polls online which indicate that traders are expecting a 100% chance of a rate cut next month. But nonetheless, besides that, all focus will now be on the Jackson Hole Symposium with Powell's speech on Friday. So I think that'll be one important factor to watch out for. The other thing, Mangalam, which is really working in our favor is also the softer Brent crude prices. We haven't really, acknowledged too much of that, but it's down around 8% this year in terms of Brent crude and currently at around $76 per barrel. So that too is aiding sentiment. Stock-specific action continues. Likes of Glenmark, Gillette, HDFC, AMC, HDFC Life, all of these stocks at fresh 52-week highs. And not to forget, all of the deal action taking place. All of the deal action taking place as well, Ekta. You spoke about Brent. Let's talk about Trent as well. It's that kind of a day where Brent is down and it's positive for the Indian markets, as a result of which positive for a lot of these mid-caps as well. So Brent lower, Trent higher is what we're seeing. But, that wordplay aside, it's been a very, very remarkably strong week for the broader markets itself. Pull up the advanced decline lines. Those green parallel lines have been the way they have from the start of this week, and this is the fourth straight day where even as the Nifty is consolidating with a mild positive bias, the broader market health is looking extremely strong, with almost on an average on a daily basis nearly 3 to 4 stocks advancing for every one stock which is declined. The Nifty Bank is now at that 51,000 mark. Remember, yesterday in the last hour itself saw a bit of an up move, closed closer to the 20-day moving average, has conquered that, and just 300 points from here would be the 50-day moving average. So what happens to the Nifty Bank is something that we'll have to watch out for, more so because it's the Nifty weekly options expiry, and the street is positioning itself for an expiry around that 24,850 mark as well. If the Nifty Bank sustains its up move, then maybe we see a breakout on the Nifty as well, as those call writers cover their positions. A bunch of stocks in focus. So let's start with the first corporate that we have for you on our show, Star Health. Joining us from the sidelines of the Motilal Oswal 20th Global Investor Conference, Nilesh Kambli, the CFO of the company, joins in. Thanks a lot, Nilesh, for joining in. Always a pleasure speaking with you. There was a larger 4-year target, 2028 milestones, which Star Health had set itself for. What would those numbers have been on gross written premium, combined ratio, market share? If you could give us some more details on the target that you've set for yourself.
So to begin with, on the gross written premium, we are talking about doubling of the premium from 15,000 crore to 30,000 crores. What it means is it means a growth rate of 18 to 20% over the next 4 years. When it comes to profit, we are talking about tripling our profit from the current 850 crores to around 2,500 crores. This will entail a combined ratio in the range of 95-96%. And in terms of market share, currently we are at 33% market share in the retail health business. With the kind of growth that we are talking about, we'll be at around 35% market share for retail health.
Oh, fair enough. Just to, become a little more granular, you took around 17 years to reach that 15,000 crore in gross written premium. And now you're saying you'll add another 15,000 crores just in the next 4 years. So how much do you expect your gross written premium to grow this year and subsequently next year, next 3 years, say individually?
So, to start with, where this growth will come from, what we're talking about is 4 channels. You know, the ABCD of our growth: the agency, banca, corporate, and digital. We will be firing on all the cylinders. When it comes to agency, we are adding almost 80,000 to 1 lakh agents every year, and that's like a staple food for us. It will steadily grow in that range of 15 to 16%. When it comes to banca, we have more than 55 partners, and we are, as we speak, we are talking to more partners. That is a business which is growing in excess of 25-30% for us, and that will continue to grow. We have invested a lot in terms of manpower for this channel. Corporate channel, again, we are focusing more on SME and MSME businesses. We have again created a team for corporate business. We believe this should grow much faster than our overall growth rate. We believe in the next 4 years, this should be in the range of 15% of our overall business. And that again is a big channel of growth for us. When it comes to digital, we have increased our capacity when it comes to our telesales unit. We are spending a lot on our web sales and telesales put together. This channel is again growing very well for us. We have invested a lot in this channel, and we believe that's the next phase of growth that will come for us. So across channels, A, B, C, D, we see that the growth will come for us, and which will take us from this 15,000 to 30,000 crores. For the current year, we are again planning a similar growth rate of 18 to 20%, you know, focusing on group, digital as well as agency business. So it will come across the channels over the years for us.
So if we take your past performance as a precedent, you know, by FY28, you can probably make, what, 30,000 crore in gross written premium. The underlying profits then could be 500 crore, more than 500 crore. Is that a fair estimate?
Yeah, absolutely, yes. You know, on a GWP of 30,000 crores, we're talking about a combined ratio of, say, 96% also. It's a 4% margin, which is around 1,200 crores. You know, after reinsurance, after the earned premium logic, it will be higher than our 500 crore number. That's absolutely fair.
Okay, all right. And do you stick to your guidance of bringing down your combined ratio by 200 basis points by FY28 and 50 basis points each year? Yeah,
when it comes to combined ratio, what we have said is for the current year, we'll be able to improve it by 100 basis points. Having said that, on an ongoing basis, we want to maintain a range of around 95-96%. You know, an improvement in combined ratio means that we are increasing prices from the customers and reducing the loss ratio, which we don't want to do. You know, we want to keep the prices stable. We want to make money by bringing in operating leverage and improving the expense ratio. So as long as we are able to meet our ROA profits, we want to operate in a particular combined ratio range, which should be beneficial to the customer. That's the long-term objective of the business.
All right. What about, health insurance? You currently are the second largest by book. When do you see yourself becoming the largest?
See, while the objective is to grow the business, it will be a function of what the market grows in, but the kind of profitability pressures which each companies have, many of the companies will get listed. We believe that we should be the largest health insurance player in the industry because we have the highest retail portfolio. It's very easy to increase in the group business, but we want to do that business also profitability. So the kind of growth numbers that we're talking about, the kind of pressure which players in the industry will have, we believe we should be the largest health insurance players in the next 3 to 4 years.
Okay. All right. Now, coming to the price correction of about 10 to 15% in 1/3 of total policies, how much do these policies form as a total of your premium? And how much do you think could be the precise increase with regards to adding to the premium?
So what we have maintained is price increase is an continuous phenomenon when it comes to health insurance. Whenever a product starts hitting a certain loss ratio threshold, we go in for a price increase. So as we speak, we have taken a price increase for 2 of our products in the range of 10 to 15%. As we speak, we are evaluating products where the loss ratios have started taking, reaching a certain threshold level, and we'll be taking price increase in the next 2 to 3 months, kind of a thing. When it comes to financial year FY25, we believe around 2% of the overall growth will come from the price increase that we have taken. Because this is a smaller price increase compared to a large price increase that we had taken for our flagship product last year. These are pretty normal price increase in the range of 10 to 15%, which will not have a very big impact when it comes to growth of overall business.
All right, always a pleasure speaking with you. Thank you so much for joining in. The street likes what you've said, 18 to 20% sort of growth over the next few years, looking at a 30,000 crore gross written premium, which would imply profitability over 500 crores as well. Stocks been doing well, holding up with gains of about 3% as well. But over the last few days, if you see, there has been a bit of a marked uptick in the share price of Star Health itself. Take a short break, come back. We focus on the big deal that was announced late last evening. Zomato buying Paytm's ticketing business. What does it mean for the companies? What could the valuation play be here with District? We'll talk about all of that also with market expert Prakash Diwan joining in.
Welcome back. Well, in an important M&A, Zomato has finally acquired Paytm's ticketing business for a little over 2,000 crores. Manglam is here to tell us more about how Zomato plans to grow the third B2C vertical in its portfolio.
Well, it's been over 2 months of reportage speculation and the companies talking about being in talks with each other. The final announcement has come by. Zomato's acquisition of Paytm's ticketing business for a little over 2,000 crore is their new bet on the going out business itself. So what they've done is they've announced a foray into that through also a District app that the company has said could launch anytime in the next few weeks as per Deepinder Goyal as well. Now, this will be their third B2C app after the roaring success of both Zomato as well as Blinkit. Soon, we'll have another app on your phones called District. So to understand what could Zomato's acquisition of this and how big could it be from a shareholder value creation perspective, let's look at a few numbers. As of FY24, Paytm's ticketing business did a gross merchandise value of close to around 2,000 crores, implied take rate of 15% and revenue of 297 crores, adjusted EBITDA of close to 29 crores. What do these numbers mean at a deal value of 2,048 crores? The deal was done at 1 time gross merchandise value and nearly 7 times sales itself for a business that, like I said, has an implied take rate of 15% and margins at 1.5% of GMV. The important thing then to see is how much can Zomato scale it to. Post-acquisition, Zomato intends to transition customer traffic from Paytm Insider Ticket New apps to District and incentivize customers to move to District itself. What is it that they are targeting? For FY26, they are targeting cross-order value at over 10,000 crore rupees with rapid growth, implying a 40% CAGR. From a medium to long-term perspective, they also are expecting 4 to 5% of margins as a proportion of GOV. And additionally, they will further scale this business depending on newer use cases like even shopping, staycations, travel, etc. So assuming all of this holds true and using a conservative estimate versus the company's own guidance, FY27 GMV for this business could be 20,000 crore, a whopping 10 times versus what they bought it for FY24. The GMV margin could be close to around 3%. This compares with 1.5% where it stands at right now. And that would result in a 600 crore absolute EBITDA. Now, if you look at the current deal multiple of GMV itself, this business could actually be worth nearly 20,000, 22,000 crore, which is a 10 to 12 times valuation jump versus what they've paid for this business. And this is without accounting for new use cases, further synergies, and perhaps, IP valuations of some of the live events that they would do under District as well. Now, usually you would say that 10 to 12 times jump in 2 years seems extremely high for other deals. For Zomato, it's something that we've seen already. Blinkit is currently 20 times what it was versus what Zomato paid for it in 2022, with brokerages citing further upside on that as well. So the bottom line is the street expects at least 10 to 12 times valuation extraction from the District app, which the management has earlier said will be their third major value driver in the B2C space.
Okay, all right. So let's see whether they can make the magic again. Thanks, Manglam, for that. Market expert Prakash Diwan joins in to discuss his view with regards to both the companies, Zomato as well as Paytm. Prakash, thanks very much for joining in. Well, let's start by talking about Zomato. Do you think that they would, be able to recreate that magic that they did with Blinkit with this particular acquisition?
Good afternoon, Ekta. I don't see any reason why they can't do this. Two reasons I say this. The first is they've done this with a much more complex business, which involved a lot of on the ground work in terms of the delivery, the quick commerce business of Blinkit. That was fairly complex, challenging, and they managed to do this. Here you have a ticketing business which is much more linked to and aligned to entertainment, and the combination of food and entertainment, all of us know, is very compelling. So that's one. The second reason why we can really sweat this out is it's a business that has not seen much of investments from the Paytm stable. So the competition, if you look at Book My Show, stands at a fairly significant size and scale. So there's enough arbitrage in that side, or there's enough delta this can create to match up with the market leader. So I don't see any reason why that. And the last is District as an app, as an application itself is very well aligned to entertainment, apart from going and eating out and all of those things. So it works well. And the last thing is, of course, 2,000 odd crores is a very compelling valuation to buy this. For Paytm, of course, it's an advantage because they've not paid too much when they acquired those two businesses as part of this ticketing business. And they've also scaled up. They've also made good money in this transaction. So it's kind of win-win, as I can see at this point.
Well, a win-win deal, as it were. Prakash, but the differentiator between, say, something like a Blinkit or something like a Zomato versus District will be that when they entered Blinkit, or quick commerce, it was a space which was evolving. When they entered food delivery, it was a space that was evolving. But now ticketing already has a big established leader with over 60-70% market share and good market positioning as well. In that, what do you think will be Zomato's right to win and their ability to actually extract the sort of value that maybe Paytm Insider couldn't?
No, that's a valid question, Manglam. But my sense is you have Zomato launching itself with the District app into an altogether new segment, which is, a space where nobody else is present. So in that sense, if they very closely align the ticketing business with the District app, there's enough scalability. So it's not something where they just have to challenge the Book My Show market share, but they'll probably create a market itself for themselves. And that is something where I think they are banking on in this transaction. It's if you look at the projections on the GMB, very clearly they are talking about very good scale and very good multiples, because they're confident that the District app itself will originate a lot of business for them. So, as I said, it's not a competition just eating into the Book My Show market share, but it's creating a new market for yourself, I think.
Okay, all right, fair enough. That point is taken. Creating a new market for yourself, and they've been there, done that. But Prakash, Paytm now, Vijay Shekhar Sharma has been quoted in saying that, he eventually wants to focus on making a long-term, sustainable, profitable business model. And it's gone through, obviously, a rough time. Even the Q1 numbers, the loss was massive. But do you think that it's probably turned the corner now with this particular transaction? And what would it do to its balance sheet and overall business?
So, yes, if you look at what they paid for this business and what they're getting, it's definitely a very attractive multiple. But is it big enough to fill that hole? I don't think so. The balance sheet still needs much more capital to get out of the woods in that sense. But this is at least a good move because it's non-core. And all those non-core activities that Paytm had got into was to a large extent responsible for stretching their balance sheet too thin and then the failure. So I think it's definitely a smart move, but I don't think, it's a step in the right direction, Ekta, but it's not enough to move the needle to kind of get it completely out of the wood and rejoice after this transaction as if everything is going to be now sorted just because you're getting these 2,000 odd crores.
All right, let's put the same thing back on Zomato then. 2,000 odd crores is the deal. Even if it becomes, say, 10-12x from now in terms of a valuation for this business itself, comes to around 20,000 crores, which is actually more than what Book My Show is valued at. Even then, it accounts for no more than 10% of Zomato's overall market cap. So while it becomes a value driver, does it become a valuation driver for the company itself in their overall SOTP? Because again, it's too small to move the needle, right? The way Blinkit grew and added to Zomato's overall valuation, do you think District could replicate that, or it would just be one of those side dishes, pun unintended?
No, very, very well put, Manglam. And I like this differentiation between the the value driver and the valuation driver. I don't think this is a valuation driver as yet, but it has the promise of giving a lot of substance to the District app. And the reason why the District app becomes very important in Zomato's scheme of things is you have the food delivery business and, of course, the Blinkit business. And now with this, what they're trying to do is just trying to reduce cyclicality in that business, or not have dependence only on just one nature of business. So it's going to be something which they can diversify themselves far better, and the sum of parts will be far bigger. So from a valuation perspective, you'll probably start seeing that once the District app matures, the ticketing business gets integrated, and which would probably be 12 months from now. So I think it has the promise, but not yet something which, and that's exactly what the stock is telling you, that it's we priced it well enough in terms of all the good things that are there, which we have seen. But let's not kind of get ahead of ourselves and price in what's going to come after 12 months. So somewhere around middle of the next 12 months, you'll probably see all that getting triggered, but not as yet.
Okay, so let's narrow it down in terms of specifics on what you are advising when it comes to Zomato as well as Paytm. What is your call on these two stocks specifically?
So I've made it clear, Paytm, I'm still not convinced that it's a buy, just on the basis of what we've seen recently. I mean, it's moved out of the ICU, but it's still in a ward. It hasn't kind of repaired itself to that extent. But Zomato is showing enough promise to be added to portfolios, and you will see this happen in a lot of institutional portfolios, a lot of HNI portfolios where significant stakes will come in. But the range that you would buy in would probably be anywhere between 200 to 230, 235. That's where I think it's fairly valued. Right now, it's a bit of exuberance. News flow has been very positive, but on certain good days, when markets give you that opportunity, that's when you buy. So it's definitely a buy for at least a 4-5 year kind of a thing, and where you could expect a multiple 2x, 3x happen very easily. But as I said, don't be in a hurry to buy it just because everything is falling in place all of a sudden in the last 1 week.
Take that point, Prakash, entirely. The vagaries of the bull market. Back in the day when Zomato would get into, different verticals, people would say it is adventurism and they should not do that anymore. But now things are looking good for them. The stock price has moved 7-8x. People are saying, okay, this diversification is good. Earlier it was consolidation and focusing on the core itself. Thank you for joining in with your perspective. We take a short break on that. We'll come back on the other side. We talk about all that's happening in the market, get you set up from the F&O perspective as well. Welcome back. You're watching us here on Halftime Report. It's midday on Thursday ahead of the Nifty weekly options expiry. Perfect time to set you up for the F&O setup at midday itself. Doing fairly good for the market, around 24,830 for the Nifty. The Nifty Bank's been the star of the show so far with a gain of almost 0.2%, holding around that 51,000 mark as well. And the mid-cap index, of course, has been the star all through this week itself. The Nifty Bank, why this is important is largely because, one, it's crossed past the 20-day moving average of 50,700, and it's just about 500 points away from the 50-day moving average of 51,400 as well. So does it cross past that or not will be the question that we'll get an answer to in the next couple of hours, because the answer to that is related to where the Nifty goes from here. There has been already a fair amount of short covering in the 24,700 call writers who are hoping for the Nifty to find some resistance around that 24,850 mark. But the Nifty, the fact that it hasn't broken below today's high is, telling you that there is a fair amount of support on the way up. And also we're seeing some put writing at the 24,800 mark, telling you that again, the street expects support to come by around that 24,750 odd as well. On the way up though, there are 2.5 crore shares at the 24,800 call for a premium of 33. And we have a fair amount of writing done at the 24,850 mark as well. So if the Nifty sustains here, then we can see all these guys running for cover, and perhaps we could see a bit of an up move in the second half of trade. Or else, you know, these guys get validated and the Nifty actually goes back to the lower end of the range, which is closer to 24,750 itself. For individual stocks, we have a bunch of them. RBL Bank, Chambal Fertilizers, IEX, all of them were flitting between in and out of F&O band. But now with the open interest action today, seems like they can go back into the F&O band. So that's about the F&O setup at midday so far. We take a short break, come back. On the other side, we have the management of Updater Services joining in to decode their business outlook. Raghu Tangarila, who is the chairman and MD, joins in.
Welcome back. Well, we do have the details with regards to the Nucleus Software buyback. So it's worth around 72 odd crores as a total, and it's come in at 1,615 rupees per share. That's what the board has approved. It equals to around 1.67% of their total equities. So that's the update which is coming with regards to Nucleus Software. But the stock, as you can see, is down around 4.5% at this point in time. We'll get you more details. But as of now, we have a management to talk to. We have Mr. Raghu, who's the chairman and the MD of Updater Services, joining in to discuss the quarter gone by and what the business is looking like. Mr. Raghu, thanks very much for taking the time out. Well, you know, I just wanted to start by talking to you about your integrated facilities management business, which is the bulk of your business. It was up around 6.2% on a year-on-year basis, up around 1.1% on a Q-on-Q basis. You have indicated that, you know, Q2, Q3 generally sees better growth. So what is the kind of growth that we're looking at in Q2 and Q3?
On the IFM side, I think between first quarter last year to this year, first quarter is about 7.5% growth. Like I called out last time, we had exited unviable business, so this growth is slightly muted. However, for this current year, what we had guided was about 15 to 16% growth on the IFM side.
Right. You know, what's interesting is that from the time when we started to speak from your IPO days to now, there's been a sharp increase in the contribution that has come in from the BSS business, which is a higher margin business for you, and that's reflected in your overall EBITDA margins as well over the last many quarters. So going forward, what is this proportion likely to stabilize at? And at that level, what are your margins likely to be? Because IFM, while it's growing slowly, it's a low margin product and there is increasing competitive intensity. In BSS, while it's growing fast, I'm sure at some point there could be worries about margins there too. So on an overall steady state basis, what is the sort of margin and contribution that you expect from both these businesses?
Yeah, great. BSS, we had consciously, strategically tried to increase revenues there, ramp up growth there because they're higher margin. That was the strategy from the beginning, and that's what is working out. On the IFM side, yes, we will grow double digit, about 14, 15, 16% this year, but the margins will be around between 5-6%. For our BSS, it will be steady state of what, 12 to 14% margins. So that has been the plan, and that's what it's actually planned out for this year, and I can see in the near future.
The contribution of BSS then over the next couple of years, you expect it to go to 40-42%. At what point does it stabilize and you stop consciously, you know, growing BSS faster than IFM?
I don't think in the near future we'll stop because we want to grow a more profitable business. As of today, it's about 35% of revenue and about 65% of our PAT. So that I think consciously will grow this, I mean, as much as possible. That's the idea. But this year we will reach between 60-40, 60 between IFM and 40 for BSS.
Okay, but if I just look at your IFM business in the past 4 quarters odd, it's been single-digit growth. And it's slowly scaled down. I mean, 4.8% in Q3 and then now 6.2% in Q1. But just give us a sense in terms of what is the average run rate that we can expect. Are you going to push to double-digit growth, and by when?
For the full year, we will be a double-digit growth. If you look at quarter on quarter compared to last quarter, yes, it's single-digit because like we called out last time, we have exited businesses in IFM which is not viable. So that's the reason the growth looks muted. But if you look at the full year, we will still do between 14-15%.
So when you talk about these unviable contracts or the businesses that you exited, what was the reason for exiting? And has that improved the margins within your IFM segment? And if so, to what extent?
Absolutely. I think it would margins would improve compared to last full year to this full year coming 25 March, would about close to about 50 to 75 basis points. That is a margin improvement we will have. When we say we exited, business is not viable, is not very profitable, or operational difficulties to do in certain geographies. So this is a conscious call, and I think that was the plan earlier also.
All right. So margins will improve this year. Final question before we let you go. On the recent increase in investment in Denave Limited, Denave India, I don't know how to pronounce that. You increased your stake from 67% to closer to 90% at 50 crore rupees, 52.57 crore rupees. If you could tell us, if there is any commitment for you to increase further stake out there, the rationale for actually increasing your stake here, and how much more are you looking to increase your stake in some of the other subsidiaries that you've acquired earlier?
No, all our subsidiaries are 100%, but for one company called Athena, which is 76% as we speak. Denave, we've already acquired 100% as of last year, 31st March, but the money moved later after 31st March. So our strategy of acquisition is we don't acquire 100%. We take a majority on day one and give an earn-out model for the promoters for about a couple of years. So Denave is 100% subsidiary as of today. So there's no more investment in Denave. That's over. So there's only one subsidiary, Athena, which will happen next year.
And how much do you intend to
that depends on how they perform. It could be anywhere in the region of about 30 to 40 crores because we have an earn-out model.
Okay, so you would be investing around 30 to 40 crores in this additional subsidiary. And where are you getting the funds from?
These funds are through internal accrual. And already, if you look at the way we account, we take it 100% in our liability in our books. It's already accounted because we're committed to buy.
Okay. Right. Any more unviable contracts that you would be exiting?
In the IFM space, no. We are now done with it.
Okay. All right. All right. Well, we're going to let you go on that note. Thanks, Mr. Raghu, for joining in and taking us through that conversation. Well, that is updated. That stock is up around 3.3% at this point in time. They are targeting double-digit growth in their integrated facilities management segment. So that is what they're looking at for the year. We'll take a break, but more on the markets once we're back. Stay tuned. Welcome back. Well, just watch out for a couple of these stocks such as IOL Chemicals, Aarti Drugs and Newland Labs. All of them are higher in today's trading session. There's a positive note which has come out from Antique, which has said that they've seen a continued reduction in prices of key APIs, and API prices have fallen sharply in the past 12 odd months. So they expect the EBITDA margins to improve for most API companies from FY26 onwards. So that's the reason why you're seeing a couple of these stocks higher in today's trading session. They've named all of these companies in their report, indicating that these are the API companies which would be in focus on account of that. But Mangalam, let's move away from APIs. You're looking at jewelry stocks in our Value Plus segment. Tell us more.
That's correct. Jewelry stocks came on my radar because of this big move that we're seeing on Kalyan Jewellers, where Wahlbergs Pincus has sold its entire stake via block deals. They held about 9% stake as of June, and of which 2.36% has been bought by promoters, and the remaining 5.7% has been bought by institutions itself. So stake going in good hands. At the same time, the selling overhang being done itself. But that brought my attention to the way all these jewelry stocks have performed in this year itself. If you look at it, Titan is the only one which is an underperformer there, down about 2% from the start of this year. But you have big moves in the names like Thangamayil, you have Kalyan Jewellers, you have Senco, you have PC Jewellers. A list of all those stocks comes up for you. And what really stood out for me is that, one, all these organized jewelry players are doing well. So organized market is growing between 36 to 38%, which was just about 22%. And at the same time, they're growing at 2 to 2.5 times industry average as well. This is as per a note coming in from Motilal Oswal earlier this year itself. If if you look at the performance as well, the lesser players are actually growing at a faster clip and also gaining margins as well. So Titan, for instance, saw a revenue growth of 32% with a margin dip of 80 basis points in the first half of this year. Kalyan Jewellers actually saw 30% revenue growth and margin improvement as well, as did Thangamayil, a 200 basis points improvement in the margin. What really stood out for me was the up move that we saw in PC Jewellers of 133%. If you look at their performance, I look back and, it seemed like a bit of a turnaround in the first quarter itself. 401 crore versus 68 crore year-on-year revenue. On the EBITDA front, it was a gain versus a loss, and the net profit as well, led by lower finance costs. What is it that's happening in PC Jewellers to warrant such kind of a move? Well, one, they're coming out of the woods when it comes to balance sheet issues. The company's submitted offer for one-time settlement to 14 banks, of which 13 have approved the offer itself. And these are data points that the company is given to the exchanges itself. And they also have an additional shareholders approval to raise 2,705 crore via warrant. So those are some of the fundamental changes that have taken place in PC Jewellers itself. So they've approved, they've gotten one-time settlement for the debt that they have. They're raising some funds, and as a result of which the stock has also rallied about 133%. Remember, PC Jewellers in the past has been a massive, massive wealth destroyer. But if things are turning around, maybe the street is betting on that one as well. Just keep an eye out on their balance sheet and growth practices going forward as well. That's all the value plus that one has to add on the jewelry sector itself. But take a short break, come back. As always, Manisha Gupta joins in, and today with her, she has a very special guest. The MD of Amul, Jain Mehta, joins in. Stay tuned.
Welcome back, and joining us is a very special guest. Mr. Jain Mehta is MD Amul, and he joins us on CNBC-TV18. Mr. Mehta, congratulations, as Amul is awarded world's strongest food brand with a AAA+ rating by the Brand Finance's Food and Drink 2024 report. Well, you have been the top dairy brand earlier. What does it really mean in the sense of numbers for you?
It is a great matter of pride and happiness for the 3.6 million farmer families who own the brand Amul, that Amul has been rated as the strongest food brand in the world. We've already been ranked as the strongest dairy brand in the world. But for a cooperative to get this recognition at a global platform gives a lot of happiness and encouragement to all the efforts that we've been putting to position Amul not just as a dairy brand, but as a food brand, which connects the producers with the consumers. And overall, the several initiatives we took over the last couple of years, be it getting into organics or getting into products which are not just dairy, but adding value to the producers, be it the potato-based snacks, the dairy-based snacks, the honey, the protein range of products, and so on, which connect the producer with the consumer and at least spread the cheer for both is what is a recognition of this effort. And we are very happy that first time, and if you look at the list of the top 50 valuable brands in the world, there is only one cooperative brand, an Indian brand, which is Amul. So it's indeed a matter of happiness, but also responsibility for the brand to continue to work both in the interests of the producers and consumers, and not just in India, but in different parts of the world, and build the great Indian story and the Indian brand that we have been responsible for.
Oh, absolutely, Mr. Mehta. As you said, a top Indian brand, and not just that, top cooperative Indian brand in the first 50 as well. Let's talk about the Indian markets then. And you hold 75% of market share in India when it comes to milk. It is 85% when it comes to butter, and a long, tall 66% when it comes to cheese. So what is the demand growth that you are seeing in all of these categories now going forward, especially with the festival season around the corner? And also, it would be very assuring to hear from you that there is no, milk price hike coming in during this festival season.
Yes, the summer season has been good, which gave us good growth in categories like ice cream, categories like beverages, categories like buttermilk, dahi, and the fresh products one. And the festive season, which has started with a bang, have also given us good growth in most of the other categories, be it the mithais or the butter, the cheese, the products we eat outside, like go into the Horeca segment, paneer, and all that. So we anticipate a very strong demand in this ongoing festive season. And of course, the markets are very good in terms of the demand as far as our dairy products are concerned. And the pricing is also quite reasonable and stable. So we don't anticipate any increase in prices of any of the products. And after the the winter season, the festive season ends, we'll have the winter season, which is also flush season for milk, which means enough and more milk will come in the system. And things are pretty good for the dairy industry, both from the production side and the consumption side.
All right. No milk price hike and no milk product price hike is good to hear for the rest of this festival season. Also, Mr. Mehta, is Amul launching new products now during the festivals? Are you setting up higher capacities? Can we expect this festive season from the house of Amul?
Purest of mithais. Apart from that, of course, the goodness of all the dairy products, and we want everyone to stay healthy, everyone to eat safe food, and that obviously enjoy what we are doing with our family and friends. So this is where we will be bringing in new products in the mithai space, in the chocolate space, in the ice cream space, and of course the range of protein products, which will encourage each one of us to stay healthy. Amul's organic push is getting a very good traction. And obviously, when consumers want to stay healthy and safe, you need to eat food without chemical fertilizers and pesticides. And we are expanding our presence across categories in organics in the country. So all in all, it should be a safe and a happy festive season for all of us. And that's what we are working towards.
Mr. Mehta, there has been a lot of conversation in the last couple of days when it comes to e-commerce, and we do understand that Amul is an omni-channel market. How is Amul making use of e-commerce, quick commerce and distribution network?
See, we have to follow as a big brand an omni-channel strategy. So we have a network of 20,000 distributors who sell to more than a million retail outlets across the country. So that forms the strong foundation of our distribution, reaching out to all towns with population of 10K and now almost 5,000 population across the length and breadth of the country. We have a network of 10,000 Amul parlors which sell the entire range of Amul products. We deal with the modern trade, we deal with the e-com and the Q-com players to see that the consumers who have changed their shopping habits also get their entire range of more than 1,000 plus Amul SKUs on their phone and the fingertips in their own home, delivered at their own houses. On top of it, we have set up our own direct-to-consumer channel and shop.amul.com, in which we sell our entire protein range exclusively on that platform through our 13 delivery centers across the country. In another few months, we will convert all our 80 plus branches into the Q-com hubs and e-com hubs, so that we reach out to more than 25,000 pin codes within 24 hours of their placing the order. So this is an omni-channel strategy which is working very well and making Amul available to every single customer everywhere across the country. And that's where the efforts are, and we are getting good results. And we're seeing more and more traction across our product categories. Some categories like ice cream, milk, paneer have a larger share of purchase through the Q-com channels, which is also we are leveraging very well. And the mithai also is getting very good traction during the festive season.
Oh, well, absolutely. And that is one category that will even see higher numbers when it comes to festivals. And I remember you telling us that during Raksha Bandhan, perhaps Amul, Kaju Katri and Peda did the best when you look across mithais there. But thank you so much, Mr. Mehta, for joining us, and congratulations yet again for that very, very strong, prestigious number. But with that, that's a wrap on Halftime Report. Business Lunch will take all the action ahead.